Hello, Jayson here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. It's a tremendously important and volatile time for the market, and especially for interest rates. The biggest inflation surge in decades pushed rates to their highest levels in 14 years by mid-June. Since then, there are signs that things have leveled off, but no compelling evidence for a reversal. The Federal Reserve is at the center of this high-stakes game. The Fed is closely watching inflation and job growth to determine how quickly it needs to react with its main policy tool, the Fed funds rate. The Fed funds rate is very different from mortgage rates or 10-year Treasury yields, but the expectations for future Fed fund rate changes are very important. The previous chart shows 10-year yields peaking along with the Fed funds rate hike expectations in June. Things changed in August. Lower run rate hike expectations surged after a very strong jobs report. Upward momentum continued as other reports added to a more upbeat economic outlook. I think that you, the American people, may have a different economic feeling. Stronger economic data coincides with higher rates in general, but it's doubly important right now, while the Fed is considering whether it might be time to slow the pace of rate hikes from the recent pace of 0.75 of a point. And moreover, the Fed has specifically pointed out that the jobs market is, quote, too hot. Go figure on that one. It may seem odd to consider that unemployment could be too low, but the Fed has reminded the market on multiple recent occasions that its primary focus is fighting inflation. One of the only ways the Fed can do that is to hurt the economy with higher rates, thereby driving demand lower. In that supply-demand scenario, prices theoretically need to fall to meet demand or at least stop moving higher so quickly. Some indicators already suggest a shift has taken place in inflation. For example, this week brought the release of a key manufacturing sector index from the Institute for Supply Management. While the overall index didn't budge, the sub-index that tracks inflation fell sharply. Now, while this was great news in of itself, other inflation metrics remain far more important. Moreover, investors are taking the recent inflation victories with a grain of salt due to the big drop in oil prices over the last 2 months. Keep in mind, the fall in oil prices is due in large part because of demand, not just here in the US, but around the world. This reinforces the notion that if the current policy on oil were to be reversed, inflation would come back in line. The following inflation indices attempt to minimize the impact of volatility for food and energy prices. These are the numbers the Fed wants to see back around 2% before declaring any kind of victory. The previous chart highlights another challenge for the Fed. In a globally interconnected economy, overseas inflation has to be considered as well. And Europe has yet turned the same corner seen here in the US. Again, the US could help by becoming a net exporter of oil and sell it to Europe. On Tuesday, European inflation data coincided with a strong consumer confidence report in the US to push rate hike expectations to their highest levels in more than a month. As seen in the previous chart, shows rate expectations were able to recover after Friday's big jobs report. Thankfully for rates, the data showed a deceleration in the pace of job growth seen last month. This is far from instant victory for rates, though. Job creation remains very strong historically, with very few months from the past 20 years rising above the 300K mark for any given month. This week's report was 315,000. If the scaling jump in the y-axis makes it hard to conceptualize 20 million job losses in 2020 or 4 million new jobs shortly thereafter, here's how the same chart would look if I didn't include the jumps. The depths of destruction post-COVID help to explain why month-over-month job creation has been able to run hotter than normal over the past 2 years. Looked at yet another way, we're just barely back to the overall level of employment seen in early 2020. The still strong job growth was offset to some extent by a decline in the pace of wage growth, which only rose 0.3% in August compared to 0.5% in July. This could be a signal of stagflation. Stagflation is when inflation is high, check. GDP is low, check. Corporate earnings drop, also check. And unemployment is high, not checked. Not checked yet, anyway. The unemployment rate did tick up to 3.7 from 3.5%. Caveats aside, 3.7 is still exceptionally low historically. Too low for the Fed to even begin to imagine their policies have hurt the economy enough to promote their inflation goals. Rates managed to recover after the jobs data, a fact that suggests the bond market was prepared for better news. The drop in rates was also made possible by the fact that the rates had surged to their highest levels at the fastest pace in decades in the month of August. In other words, Friday may have been better, but we're still much higher than the previous week. Perhaps just as troubling as the high rates themselves is the extent to which rates have been changing from day to day. The Fed would like to engineer a soft landing for the economy. That is going to be hard to do. After all, they're using economic pain to fight inflation. Threading that needle means accurately identifying the economic tipping point where inflation will respond. This delicate dance has the market on the edge of its seat. Economic developments at home and abroad have had far more power to move markets than normal. Because the Fed deals in rates, interest rates have consequently seen unprecedented volatility. To be fair, outright volatility was a bit sharper in 2020, but that episode lasted 2 months at best. The current episode of heightened volatility is going on 6 months now. The higher the black line in the previous chart, the bigger the average difference between one day's mortgage rates and the next. It's important to understand that this is the reality of the rate market right now. I've never seen day-over-day changes of this size with such reliability frequency. As for how all this plays out, the coming weeks and months are the most critical, especially the fourth quarter. The big-ticket inflation indices like Consumer Price Index, CPI, will be tremendously important. The Fed will get to see one more installment of that in 2 weeks before announcing the next rate hike on September 21st. I already know it will be a rate hike, but the size of the hike and the accompanying verbiage could go a long way toward reinforcing a rate ceiling or demolishing it. Let's hope that we are near the end of this volatility cycle. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.